Can you get a VA loan if you're self-employed? The short answer is absolutely yes. But there are specific things you need to know about how VA loans work for self-employed borrowers. I'll also share a story about someone who navigated this process to help it all come together. Let's dive in. First, let's talk about the requirements to use self-employed income for a VA loan. To use self-employed income, you must meet these requirements. You need to, one, have been self-employed for at least 2 years. Two, you must have filed business income on your most recent 2 years of tax returns. Three, the income reported on your tax returns must show consistency and stability over time. However, VA guidelines do allow exceptions for self-employed borrowers with less than 2 years of history. Here are the conditions for these exceptions. One, you must have a strong work history in the same field. If you were previously employed in the same field before becoming self-employed, it demonstrates expertise and stability for your business. Two, you must document the success of the business. The business must show early profitability and stability. This can be verified through tax returns, year-to-date profit and loss statements, and bank statements. Three, you must show compensating factors. Compensating factors are things like a strong residual income, a low debt to income ratio, and significant cash reserves will all strengthen your case. Four, the lender must show a reasonable expectations of future income. So the lender must see that your income is stable, reliable, and likely to continue. Often they're going to do this through contracts or ongoing agreements that you have. If your self-employed history is less than 1 year, and excuse me, the VA typically requires even stronger compensating factors and documentation. Each case is reviewed individually, and the lender must justify why the income should be used. Now, here's where self-employed gets a little more detailed. For self-employed borrowers, lenders use the net income, the amount that's left over after all your business expenses, to calculate your qualifying income. However, certain expenses can be added back to your net income under VA guidelines, which can help boost what you qualify for. Here are some common things that can be added back. Depreciation is a non-cash expense, meaning it reduces your taxable income without affecting your cash flow. For example, if you claim $10,000 in depreciation for equipment or vehicles on your taxes, we can add that $10,000 back to your net income for qualification purposes. If you claim vehicle expenses using mileage or depreciation, these are often added back because they don't directly reduce your actual cash flow. The IRS standard mileage rate deduction is considered an estimate, not a direct cost, so lenders will typically add those back. Amortization expenses, such as those related to intangible assets, loan fees, these can also be added back since they don't involve direct cash outflows. If your business involves natural resources like oil, gas, or timber, depreciation expenses can also be added back as well, as they're treated similar to depreciation. Occasionally, your business will have a large one-time expense, and those may be excluded from your income calculations. Examples include equipment purchases or extraordinary losses. These are evaluated on a case-by-case scenario, so they must be documented clearly to show that they aren't recurring. By including these non-cash and extraordinary deductions, your qualifying income may be significantly higher than the net income shown on your tax returns. Now let's talk about my story. David owns a motorcycle repair shop. He claimed $15,000 in depreciation for his shop equipment. Even though his net income on his tax return was $40,000, his lender was able to add that $15,000 back, increasing his qualifying income to $55,000. This made a big difference in what he could qualify for. That's over $1,000 a month. Let's address a common misconception about VA loans for self-employed borrowers. Some people think that the VA loans have extra hurdles to jump through, and that's just not true. The process is very similar to other loan types like conventional or FHA. However, the VA loans do not offer options like bank statement loans. These loans are non-QM loans and are entirely different from VA loans and come with their own set of rules. Here are the key takeaways. Yes, self-employed veterans can absolutely qualify for VA loans, and the process is very similar to other loan types. Net income, not gross income, is used for qualification, but certain expenses can be added back to help boost your qualifying income. In the end, my friend David that we were telling a story about, he qualified for his VA loan based on his net income and purchased a home that met his family's needs without stretching his budget. The process wasn't complicated, it just required understanding of how the self-employed income works with the VA loan. Thank you for taking the time to learn about this important topic, and I hope this helps you feel more confident in using your VA benefit.